Hong Kong has long stood as a titan in the world of real estate, a gleaming city where property prices did not just soar. They established an entirely new altitude, often topping international indices for both residential and commercial property costs. For decades, this bustling metropolis, a global financial hub with an acutely limited usable land area, faced a near-constant tension between supply and demand. This unique dynamic created a market that seemed almost impervious to downturns, a testament to its economic might and allure. To truly grasp the extent of this historical dominance, one needs to look at the median multiple of Hong Kong. This crucial measure, which calculates the ratio of median house prices to median household income, consistently shows Hong Kong at the very peak globally. When displayed on a graph, the visual is stark. The cost of real estate in Hong Kong is not merely the highest in the world. It far surpasses any other economy, stretching out in isolation at the top. Comparing it to a city like Singapore, which shares similar geographical and economic challenges, one might reasonably wonder why Hong Kong government allowed this issue to persist, seemingly unfixed for so long. However, regardless of what has occurred in the past, what is far more pressing and, indeed, more important about Hong Kong real estate market today is the undeniable fact that it is now experiencing a very painful slump. The narrative of perpetual growth has been shattered, replaced by a reality of decline that is reshaping the city fabric. A detailed graph illustrating the residential property prices clearly showcases this significant decline in Hong Kong housing market. After years of relentless ascent, with prices continually reaching new stratospheric levels, the market has decisively entered a downturn. Property values are dropping, and the speed of this descent is quite remarkable. Looking at the latest quarters available, specifically from the first to the third quarter of 2024, the data is unequivocal. Real estate residential property prices have continued to post double-digit declines. This is not a slight dip, it is a substantial and sustained contraction. This situation presents quite a shock, does it not? Hong Kong, after all, has always been the most sought-after real estate market, a magnet for capital, consistently buoyed by a robust mix of domestic buyers, a steady stream of expatriates, and, crucially, a powerful influx of mainland Chinese investors. If one were to plot out the property price index since the dawn of the 21st century, the trend is almost monotonously consistent. Property prices have always been increasing. This makes the current slump not just a market correction, but a profound shift from a long-established norm. So, with this unexpected and, for many, deeply concerning slump, a critical question hangs in the air. What is truly causing this? Is this downturn intrinsically related to the broader real estate slump unfolding across mainland China? Or is it primarily a consequence of the changing global economic environment that we are all currently navigating? These are not simple questions, and the answers are multifaceted. To understand the depth of this crisis, we must delve into the interconnected problems that Hong Kong is now facing, each contributing to the erosion of its once unshakable property market. The very first problem, a colossal force hitting the real estate industry in Hong Kong, can be no other than global interest rates. To fully appreciate its impact, consider a graph detailing the Federal Reserve interest rate in the United States. What becomes immediately clear is the astonishing speed with which it has ascended in a remarkably short amount of time. Here, one can observe that United States interest rates have soared to more than 5%. This aggressive tightening by the Federal Reserve sends ripples across global financial markets, and Hong Kong, due to a specific monetary policy, is directly in its path. But what exactly does this have to do with Hong Kong? The connection is fundamental and unwavering. Hong Kong currency is pegged to the United States dollar. This means that whenever the United States Federal Reserve makes a move and raises interest rates, Hong Kong Monetary Authority is compelled to follow suit. A graph charting the interest rates set by Hong Kong Monetary Authority reveals a strikingly similar pattern to that of the United States, almost a mirror image of upward movement. This direct link means Hong Kong loses autonomous control over its interest rate policy, becoming an involuntary passenger on the United States monetary roller coaster. The problem with having consistently high interest rates is profound because it directly causes borrowing costs to rise significantly. Interest rates, set by the central bank or monetary authority, are, after all, a key determinant of the cost of borrowing for everyone. Individuals seeking mortgages, businesses looking to expand, and developers embarking on new projects. When interest rates climb, the cost of taking out a mortgage increases. For potential homebuyers, this means monthly repayments become substantially larger, making property ownership less affordable and less attractive. So, with higher mortgage costs, it makes perfect economic sense that there would be a palpable decrease in demand for real estate. The wellspring of cheap credit that fueled the market for years has dried up. On top of discouraging domestic borrowers, the fact that interest rates are high not just in Hong Kong and the United States, but globally across major economies, has created a broader slump in demand. This global tightening affects many expatriates who might consider moving to Hong Kong, making their financial calculations less favorable. Similarly, international investors, who once viewed Hong Kong property as a safe and lucrative haven, now face higher costs of capital and potentially better returns elsewhere. This collective decline in demand from multiple sources has undeniably contributed to the overall downturn in demand for Hong Kong properties, amplifying the local challenges. Now, in addition to the formidable challenges posed by rising interest rates, Hong Kong real estate market is grappling with another unexpected problem: oversupply. Yes, that is correct. Even though historically the narrative has always been one of insatiable demand encountering painfully limited supply in Hong Kong, the exact opposite scenario is now unfolding. The city that famously struggled to find space is suddenly finding itself with too much of it, particularly in commercial sectors. To illustrate this dramatic shift, consider a graph depicting the office availability rate in Hong Kong. This visual immediately showcases a sharp and concerning increase in vacant office spaces across the city. Reviewing the period from 2016 to 2017, the office availability rate typically ranged between 6 to 7%. This meant that only a relatively small portion of office spaces remained unoccupied, signaling a healthy, tight market where demand was robust. However, in recent years, this number has skyrocketed to unprecedented levels. As of the first quarter of 2024, the office availability rate has reached over 19.6%. That represents a huge, almost threefold increase in vacancies in just a few years. This stark statistic vividly demonstrates just how dramatically demand has disappeared from the Hong Kong market, particularly for commercial property. What makes this situation even more worrying is the continuous flow of new inventory entering the market. There have been recent completions in both the office and residential sectors, projects initiated during the boom times, which have added significantly to the overall inventory levels of Hong Kong. Imagine a flood of new properties coming online at the very moment demand is evaporating. This simultaneous increase in supply coupled with weakening demand creates immense downward pressure on prices. The fundamental laws of economics dictate that when supply outstrips demand, prices must fall. Some reports indicate that Hong Kong, a city that has always faced a perennial problem of limited land supply, has now forced some developers to resort to drastic measures. They are offering significant discounts, sometimes substantial ones, to clear unsold inventory. This is a stark departure from the past, where properties would often sell at or above asking prices even before completion. The current landscape is forcing developers to cut into their profit margins just to move units, a clear sign of a distressed market. Thirdly, adding another layer of complexity to Hong Kong real estate woes is a problem deeply intertwined with politics. Some astute analysts suggest that Hong Kong real estate market has also been profoundly affected by a palpable sense of political uncertainty. Following the widespread 2019-2020 protests and the subsequent implementation of national security measures imposed by Beijing, many investors, both local and international, have grown increasingly cautious about the territory's long-term stability. The perception of Hong Kong as a uniquely autonomous and predictable jurisdiction has been altered, leading to a re-evaluation of investment risks. This political shift is partly the reason why, if we revisit the graph of the office availability rate in Hong Kong, we can observe an interesting precursor to the current slump. Just prior to the COVID-19 pandemic, specifically in the fourth quarter of 2019, office availability had already begun to increase. This early rise in vacancies suggests that political concerns were starting to deter businesses and investors even before the full impact of global economic slowdowns or interest rate hikes took hold. It indicates a foundational shift in confidence. On top of this pervasive political uncertainty, Hong Kong is also experiencing another significant demographic trend, an increase in emigration. Many people, for various reasons, have chosen to leave Hong Kong. But what is far more worrying for the economy and its property market is the quality of those leaving. A report from the Henley Private Wealth Migration Report highlights this concern, stating that over 1,000 high-net-worth individuals had departed Hong Kong in 2023. This statistic is critical. It basically means that millionaires are also leaving, and with them, they are carrying their considerable wealth. This capital, which has long been a primary reason for Hong Kong economic strength and a key driver of its luxury property market, is now exiting the city. The departure of high-net-worth individuals represents not just a loss of population, but a significant drain on the financial ecosystem that once buoyed the most expensive properties. Finally, one last, but by no means least, reason for Hong Kong real estate slump can also be attributed to the far-reaching ripple effects on its banks and property developers. The property slump is not confined to homeowners and investors. It has extensively rippled into the core of the financial sector, creating significant vulnerabilities. Consider the case of HSBC, a major financial institution with deep roots in Hong Kong. The bank saw its credit-impaired loans on commercial real estate in Hong Kong surge nearly sixfold, reaching over $3 billion United States dollars in the first half of 2024. This dramatic increase indicates a growing number of loans where the borrowers are struggling to meet their obligations, signaling rising risk within the banking sector. While many borrowers are still servicing their debt, the rising defaults on property loans have undeniably increased the overall risk profile for banks operating in the territory. This makes banks more cautious about lending, further tightening credit availability and exacerbating the market downturn. Likewise, major property developers, once considered unassailable giants in Hong Kong, are now feeling an intense squeeze. New World Development, one of Hong Kong's prominent developers, reported a staggering net loss of over $852 million United States dollars in the first half of 2025. This is a colossal loss for such a well-established entity. Furthermore, its market capitalization, a measure of its total value, has fallen by more than 80% since mid-2019. This precipitous drop reflects a dramatic loss of investor confidence and a re-evaluation of the company's long-term prospects in the current market. These developers are facing a perfect storm. High debt levels, accumulated during the boom years when borrowing was cheap and expansion was rapid, are now coupled with rapidly falling property values. This combination has left many developers with exceptionally high net gearing ratios, indicating a heavy reliance on debt, and looming debt obligations that are becoming increasingly difficult to meet. These immense financial pressures can lead to a cascade of negative outcomes. Asset write-downs, where the book value of properties is reduced to reflect their true market value. Restructuring of debt, often involving painful concessions to lenders. Or, in extreme cases, even default, which could have systemic implications for the broader financial system. So, as you can now clearly see, the real estate slump in Hong Kong is not the result of a single isolated factor, but rather a complex interplay of many powerful forces. It is a confluence of global economic shifts, internal market dynamics, political uncertainties, and structural financial vulnerabilities. Now that we have explored the causes, let us turn our attention to what the impact is for Hong Kong economy, and why some of these effects are undeniably bad, while some, perhaps surprisingly, can be seen as good. The biggest and most immediate problem that the real estate slump would cause is no other than its profound impact on government revenues. To understand this, let us examine a graph depicting the revenue from land premium of Hong Kong government. This data illustrates precisely how much revenue the Hong Kong government collects from land premiums, which are essentially fees paid by developers to acquire land for construction. Historically, land premiums have long been a massive and reliable contributor to the government revenue. The sale of land, particularly through highly contested auctions, was a golden goose for the Treasury. However, for the latest year of 2024, the city is projected to experience a significant slump in this crucial revenue stream. This is not just a minor fluctuation, it is a structural hit to the government balance sheet. To truly convey just how massive this impact is, let us graph out the government revenues of Hong Kong in the 2021 to 2022 budget. Here, one can clearly see that land premiums contributed an enormous amount, over $97 billion. This made them a far greater source of income than stamp duties, salaries tax, and investment income combined, highlighting their central role in financing public services. But now, if we graph out the government revenues from 2024 to 2025, the picture changes dramatically. We see land premiums drop sharply, becoming the least contributor amongst the major revenue sources of the Hong Kong government. This shift is alarming. It means that this slump in real estate is indeed going to hit the government the hardest, forcing difficult decisions about public spending and potentially leading to budget deficits. Another significant impact, and a directly felt one, would be on property prices themselves and, by extension, the personal wealth of many residents. When property prices fall, it initiates a chain reaction across the entire economy. For many people in Hong Kong, real estate is not merely a place to live, it is their primary form of wealth, often representing a lifetime of savings and investment. A substantial drop in prices means their net worth shrinks, sometimes dramatically. This can lead to a feeling of insecurity, a decrease in consumer confidence, and a general tightening of belts, which can further dampen economic activity. The wealth effect works in reverse, with negative consequences. But while that can undeniably be a problem to these homeowners and investors, there is actually a good reason why this slump might, in the long run, be considered okay, or even beneficial. And that good reason is the fact that falling home prices have directly helped to decrease the median multiple of Hong Kong. This is a crucial point for the city's long-term social and economic health. So, as we have explored, Hong Kong real estate slump is due to a multitude of powerful and interconnected factors. Its effects are far-reaching, and depending on one personal situation, they can either be viewed as bad, particularly for those holding existing property or for government revenues, or they can be viewed as good, if one is looking to enter the property market and finally afford a home in this iconic city. The future of Hong Kong real estate market remains uncertain, but one thing is clear: the era of seemingly endless price appreciation has come to an end, at least for now. Anyway, do let us know what you think. Thanks for watching.